Welcome to Wall Street Beats. Today is February 26th, Wednesday. We're here to talk the markets. With me today is Jeff Mackey and Charlie Peabody, who's furiously going through the data that just got released 2 minutes ago. So I'm going to start with talking to Jeff about the minefield that is consumer retail earnings this week. It was quite a day yesterday. Jeff, what are what's on your mind?
It's been a bumpy ride, but when I think about it, Bernard, doesn't February, March, this reporting period always suck for retail? Like, you've got a lot of downside. I wouldn't trust a company that guided much higher at the beginning of the year based on, January was sure strong. We had great foot flow there coming in, looking for the garbage that we had left over from Christmas. So you have every reason in the world to sandbag. I was looking at the Walmart numbers, which seemed fine. It was really hard to get excited about them at the valuation they were trading at, and they came in with something that was fine. Were they a little cautious? Yep, just like they were last year, and then they beat 3 straight times. So their numbers weren't great. You look at TJ Maxx, though, and it doesn't really fit. To make it fit into a larger economic kind of thesis, at least the existing ones, you really have to hammer it. You really have to just take it as a big square peg and just bash it into these round holes, because this is not a super discount customer. This is not a beleaguered, cash-strapped nobody customer. This is a bunch of customers that are taken from Target and Kohl's and just kicking the shit out of them quarter after quarter with much better margins. If you look at how Targets and TJ Maxx have performed kind of post-COVID, TJ Maxx clearly spent some time and figured out a reason to exist, and Target's lost their raison d'etre in general. And it shows up in the numbers. It shows up in the margin performance. And TJX, again, turning in another quarter. Do you trade this stock? Maybe if you have insomnia and you need a quick inducement to fall asleep, because they just crank out quarter after quarter. It's a nice kind of upward 30-degree slope, and you rest easy because they're just, sometimes companies are really good. And it never seems to have bad weather or headwind in the economy, and no one really gives that much of a shit about tariffs if your company's really good. That continues to cure a lot of ills in corporate America, and so I'm not really ready to give up on the consumer yet. I think they're who we thought they were. It was a flattish Christmas, a little better than that, and it's a flattish New Year. With sentiment polls, to me, are hilarious, especially when companies are reporting, because who gives a shit what they say? You caught me at a bad time. I'm grumpy. Things are going to hell in a handbasket ever since Nixon took us off the gold standard. The sentiment surveys mean absolutely zero. We're all good. One good commercial from flipping our sentiment entirely.
What I found was interesting was just like the number of companies that put up a quite strong Q4, but then guided down. It was the beat and guide down. That was the theme for me the last few days. Planet Fitness did that. I'm having trouble. I think maybe Carter's was another. There were like 3 or 4 where I was just like cycling through them and looking at the release really quickly. Oh, they had a good Christmas, and now it's doom and gloom. And yes, the consumer confidence numbers really tick down. To me, it feels, and I'm also biased from just coming off the CPG conference last week, which did not have a good last year. They've had a lot of things going wrong, but one of the overwhelming themes for me was uncertainty. And even where things are fine, like the food distributors had a pretty decent year because inflation was actually good for them. People going to restaurants, traffic wasn't that terrible, volume stayed up. They had a good year. But are people going to eat out this year? Is anyone in Washington, D.C. going to go out to dinner this year? Which is a bit of an exaggeration, but you have LA majorly disrupted right now. You have DC majorly disrupted. You have more corporate layoffs layering in. Nobody knows what's happening with tariffs. That was the thing that I really took away, was that you can plan, but anything could change because none of these policies have been firmed up. So it's an incredibly difficult time to be a C-suite manager of a company, because
it's hard to cure what ails the bad ones at this point. If you're a good company after the supply chain mess that we had, that cluster mess that really resulted from the lockdowns and COVID in China and everything else, if you haven't moved your distribution around a little bit, you deserve whatever you get. At this point, people, at least the smart ones, have some diversity into their chain, and they're going to be able to deal with it. And if you offer, again, the products that customers want,
you're diversified, and you could have, I would think that people who had some stuff coming from Mexico where we have a free trade agreement thought they were okay. Like you moved from China to Mexico, that was supposed to be a very safe move and it may not have been a totally safe move. So I think that what we're getting in the guidance is uncertainty on the consumer and also uncertainty on the cost base. And it's all the unknowables. It's like what you said, you're cranky this morning when you're talking to your investors. It's like every glass is half empty versus half full. Like we had a great Christmas, but we don't know what's coming. You really never know what's coming. The mind frame is around all that could go wrong as opposed to all that could go right.
And the political mojo's bad, but nobody owns these companies because they're going to make or lose a nickel based on the import cost that's coming because of some tariff. Like that's really what you're really worried about. I think you can give an excuse.
Impact. Isn't it? I think the nickel is minimizing it for some of these companies.
Maybe, but it's if they can't survive it, then the tariffs have gone way too far, and we have much huger problems than whether or not TJ Maxx hits a quarter.
Yeah.
Can I just interject here because you guys have been hitting on a theme that we've been talking to our clients about all week long, and that is the chaos theory. And there's a Russian mathematician that said that uncertainty increases exponentially with time as chaos approaches. And the point there is that forecasts become meaningless in a chaos theory. And that's exactly what we have right now in the markets is tremendous uncertainty. And so therefore forecasts become meaningless. And I'll come back to that when I talk about the banks, but that chaos theory by Lupinoff is playing resounding very loudly in the markets right now. Sorry.
For sure. It definitely feels chaotic. So anything,
you know what? I think it's we've got Target on deck, so of course this becomes Target week to me, and I don't think they're a good company right now. I think that if you were going to try to separate what Target does well, where they make most of their margins, where they are legendary for being so good, it's going to be in clothing, it's going to be in apparel, and it's going to be in kind of those soft lines that they've been complaining about for the last 3-4 years. And Walmart said that their discretionary was soft, but they gained share. Now, there's not that many places for Walmart to gain share, so we know what that means. TJ Maxx just said, hey, store traffic was great, and we're comping pretty well. And look at these 13% margins. Hey, look at us kicking ass all over the place. I think Target's going to be closer to the Walmart side of things, if not worse. And we'll see about the chaos theory. That's my expectation. I could be wrong because it's an unknowable world. But they seem like a company that's lost their way a little bit. And it's a huge quarter for Brian Cornell. Again, you take a company that's not hitting on all cylinders and a dicey economy, not great, not terrible, but there's certainly room to screw it up if you want to. And danger, Will Robbins. We'll see. It's going to move one way or the other in a big way, I think.
Hey, what did you think about the announcement? I think it was this morning that the Target's doing a deal with Champion. I thought that was funny because Target famously I think people's memories are short. They famously kicked Champion out of what was probably a 20-year deal. We're doing the C whatever line with them. And then they did that so they could go all in on their all in motion kind of Lulu dupe business that they have, which seems to be doing pretty well. Definitely
not well enough, and I don't think
well enough, right.
Champion's brand hasn't really gone anywhere. Champion's kind of
gone off a cliff, but
it's the same super thick sweatpants for kind of discount customers that it always has been. I don't think it's great. Again, Target, who knows what the hell Target's trying to do right now?
I just thought it was weird that they went back to that both sides would want to go back after such a toxic breakup. It's like you're going back. Yeah. It's like it wasn't working out for either of you. Why are you getting back together?
It's a little micro glimpse of Foot Locker next week when they're going to tell us how much they're thrilled to be back in business with Nike. Boy, we're sure happy that they're selling us shoes again. Thank goodness.
Yeah, there's definitely
Nike essentially assaulted them.
Bit of a toxic relationship there too. Anyway, Charlie, what'd you find in those numbers that you were so furiously digging through?
Sure. Yeah. So this morning, the U.S. Census Bureau released the new home sales data. It was very disappointing. It came in 657,000 for the month of January. Estimates were 680, 685 in that area. Home sales continue to be very weak. Obviously, this is very bad news for home builders. But in recent days or weeks, I've been talking about the potential for a dead cat bounce in these home builders. But many of them are off 30, 40%. And my concern was that you're going to start to see lower long-term rates. I think the 30-year mortgage rate is now below 690 and still coming down. And you do usually have a stronger selling season this in the springtime. So we could get a dead cat bounce. The problem to date, since last September when we started highlighting potential weakness in home builders, has been one of affordability. And that continues to be the case. If you look at the homes that are being sold, it's more the low end, the 500,000 to 800,000 are down year over year, whereas homes that are a million plus are up year over year. And that's bringing up the average selling price for homes nationally. But home sales continue to be very weak, and you're starting to see some weakness at the high end. Toll Brothers reported a week or so ago and had very disappointing results. The other interesting thing to watch here is you're starting to see some divergent strategies now develop amongst the home builders. So Toll Brothers said, we're going to try and maintain gross margins. And so we're going to cut back on incentives. We're going to cut back on mortgage buy downs. We're not going to give you, away closing costs, things like that. Whereas Hovnanian, which reported 2 days ago, was down 12+% on their report, said we're going to continue to offer incentives and try and get volume to clear the excess inventory. So it's going to be interesting to see who wins in their strategies, because for the first time, they're divergent. Go ahead.
Doesn't that go a little bit with, I'm not as familiar with Hovnanian, but Toll Brothers is at the top of the market for the public home builders.
Yeah.
So the lack of incentives, maybe does that tie into what you were just saying about strength at the high end of the market relative to the mid and lower parts of the market?
Yeah, Toll Brothers is offering incentives. They're just saying we're not going to keep competing on that base. Yeah, they're having, in order to clear their inventory. Actually, Jen, if you can put up that Excel spreadsheet, I just inputted all the new home sales data. It's in the salmon colored column. So the first column, starting from left to right, shows the 657,000. It's the December number was revised to up 734,000. So the decline from December to January is 10% plus. Then if you go to the far, you can see you have 9 months supply based on current sales volumes of inventory. And the absolute number of homes, 495,000 homes, new homes to be sold, continues to be at an all-time high. So the inventory build continues, which says to me that if you don't offer incentives like a Toll Brothers, you're probably going to miss on your unit volume forecast. And right now, most housing analysts are forecasting that home sales in total, existing plus new, will be up 2 to 5%. And that's because, Jen, I don't know if you can put up the chart. This shows new home sales only over a multi-year period, but it's been relatively flat over the last 2 years. And people feel like, all right, we've had 2 weak years. Now we're going to have a better year. I don't understand why you have to have a better year. Affordability is still a problem. And then and this is a big if, but if we start to have unemployment problems, then I think you could actually have a down year in terms of home sales. And that's what you're starting to see in places like the DC, Virginia area, which has been hit very hard by the DOGE effects of cutting back government. There's a tremendous amount of supply developing. So where I'm going with this is, at the end of the day, and this feeds back to you guys, I've always said that we're moving now towards a housing crash, where we're probably, the next leg is going to be defined by higher unemployment. So the first leg was affordability. We're now getting our dead cat bounce. It'll be interesting to see if these home builders are up today on this very weak news. My guess is they probably will be, because I think we're in that dead cat bounce area. But the next leg down is going to be driven by higher unemployment. And in that environment, I've warned that the consumer is going to be negatively affected by the two assets that they hold deflating in value. The first is their house, and we're starting to see lower home prices in places like Florida, Texas. We're seeing weakness in Richmond, Nashville, Indianapolis. So second-tier cities are seeing weakness. So there's that negative wealth effect is going to start to impinge on the consumer confidence in their psyche. And then if stocks do unwind, and that's a big if, that's your second biggest holding of asset wealth. So I don't see, I think we're moving towards a housing crash sometime in the second half of this year, early next year. But I don't see it as being the problem that it was in the great financial crisis, in that it's not going to infect the banking system. But I think it does infect consumer confidence. So I'd be curious whether you guys think that the confidence data that we've received here recently, which was not good, was reflecting any of this, or is it reflecting other things?
I am hearing murmurings of the slowdown in travel bookings, which is like a leading indicator, right? Because you may not skip your mall trip, but then you're putting money or deposit down on a $5,000 vacation or whatever, and you may hesitate on that. So that's the sort of blood in the water that I see right now. Although I was
Stocks are still
traveling,
rocking though. The cruise
things are
stocks are still
crazy.
amazing.
What's that?
The cruise stocks are still doing they're sailing along, if you will.
No, it's that kind
Yeah.
of thing where you might be starting to see a very recent inflection point. We'll see. No, but they put up phenomenal numbers, phenomenal guidance for sure. But I think there's less certainty about where things are going to be in 6 months. I think when I put feelers out there.
And it seems like we're still
And it's
macro normalizing from the COVID lockdown type of world where we saw at first just a ton of nesting taking place, a ton of, you listen to Home Depot talk and we're a really well run company doing smart things. And everyone who's going to remodel their home did so during the lockdowns that they started, or we went through a nesting period. And that hasn't started back up again. They're not seeing any projects starting. I don't know if that's the start of a panic or just a continuation of things haven't been such great shakes at Home Depot for a while now. And for a company run as well as it is, they're just too reliant on the housing market to taking off in one form or another. Either they're through new home sales, or just people doing projects, and they're not seeing it. And they're not seeing a hint of it. And you can like it, you can pretend it's there, but they're not seeing a downturn. They're just saying, you know what, it's the same as it has been for lots of quarters in a row.
I think it's also, there's a lot of sticker shock. And this is one of the places where inflation really kicks in. You go and you look at new appliances and before the tariffs even come in, which are going to be material there, right? Between whether it's Mexico or China, it's going to be a problem. But anyway, prices were already at 20-30%. Wood is up, like all these things are up, right?
And your refrigerator costs about as much as a cheap car used to. And it's what the sweet hell is this? I don't really need that.
Yeah. So I think I think it's the same thing with travel. It's like the trip that used to be 3 is now 5. The trip that used to be 6 is now 10. Well, with remodels and stuff, there's some things that you have to do. You have water damage or something, and people suck it up. But when you see the price just is much higher than you thought it was going to be, I think that it's the confidence, and it's also the sense of value feels off for a lot of people on things.
On that front, the National Association of Realtors put out some data maybe 3 or 4 weeks ago, anyway, saying this was in relation to the talks about tariffs on Mexico and Canada. And they said 32% of all appliances are sourced internationally. And then it was something like 35% of lumber is sourced internationally. And then they didn't give numbers, but they also said significant amount of wallboard or gypsum and concrete is sourced from Mexico. So all those costs are going to go up for the home building.
That number sounds really low for me on appliances. I would have thought double. It depends on how you're defining appliances too. Are you saying small appliances as well as large?
And I think you were talking Mexico only. Mexico.
What's that?
I think they were talking Mexico and Canada because it was in relation to
just Mexico and Canada. Yeah, because if you add like Korea into that, it would go up a lot. Yeah. Yeah. So I guess the only thing I'll throw in something here, which is as I'm struggling with operating a lot, not entirely, but a lot in the consumer world and dealing with this uncertainty and dealing with a place where companies are coming at this with, in many cases, very high margins, which have nowhere to go but down, given the environment. I'm just going through my portfolio and thinking about places that that I have that maybe a little bit less exposed to the U.S. consumer, but where I can apply the same analysis. So I'll just mention like literally a month ago, I think exactly, I talked about Domino's China on the call, it was on Lunar New Year, so exactly a month ago. And it's a very simple story. Immature opening stores, proven business model. The biggest question marks for me were Chinese people like pizza, and they're like 1,000 stores in, so we know that they do like pizza. And can I trust this management? And actually, one of them is a longtime executive from Deckers. Yeah, I can trust somebody who I made a lot of money with at Deckers. It checks a lot of boxes for me. That stock is 18% in the last month. Up coverage on it. I think it was like 75 when I talked about it, 75 Hong Kong dollars. Now it's 93, 94. They put a 125 street high target on it. There are only two banks that, Jefferies and Macquarie, that cover this, that aren't local Chinese banks. So I think that with time, it's only been public a couple of years, it's going to get more coverage. And I don't think it matters at all, like what happens here for this stock. Yes, if our chaos sends the world into a global recession or some kind of global geopolitical instability, yeah, maybe it'll trickle down. The US tariffs doesn't matter. So that's one that I'm leaning into. I also am leaning into some of my sports betting stocks, which I think a lot of them have a lot of European exposure as well, secular growth stories. I'm just trying to maybe pivot a little bit away from the mall or the supercenter and look for things that are winning with consumers, but maybe a little bit less exposed to some of this volatility,
I want to echo
specific
something
to the US.
Jeff said and that you said. So Jeff, when he was talking about Home Depot, said things still are growing. And I agree. Maybe things are slowing down, but we're still going to have 1 or 2% GDP here in the second quarter. And then the other thing I wanted to echo is something you said, and that is the issue is one of margins. So in the fourth quarter, most companies, as you pointed out, beat in terms of both revenues and earnings or one or the other. But they guided down. And the real issue was margins. And we're looking at record margins, where corporate margins are running around for the S&P 500 around 12.5%. I think record levels have a 13 handle on them. So when you look at earnings for the S&P 500 going from 240 last year to 275 this year, that's a double-digit increase, and that means margins have to come in, strong. And if you get any kind of disappointment on the margin front, those stocks are going to get taken to the woodshed. I think that's what you've been seeing, where disappointments on guidance have been hit really hard. And that's what happened to Hovnanian 2 days ago. It was down 12.5% on the guidance that gross margins would be weaker because they were going to continue with incentives.
And
cautious on the margins is where you want them to be. It's everyone's super cocky about their margins. When a retailer says we're not a markdown company and we never do price promotions, that's your time to sell. And so right now, when they're telling us that to expect weaker margins, TJX did this morning again, and they beat quarter after quarter, and they sandbag quarter after quarter. And I think that it's both the smart thing to do. To your point, Charlie, margins have been really high. They figure to come in, it figures to have to be more promotional. But in the meantime, we just beat Q4 by 75 cents. Are you going to believe our results or what we're telling you out of our lying mouths? Yeah, and I think that there's just a little bit of theatrics to it as well. We'll see how the data turns out. You're right. There's kind of smoke here. There's the essence of smoke. There's wafting going on. But there's also, it's a stock picker's market. You can add alpha if you're making the right picks, because it's definitely not a sweeping. Our correlation isn't going to 1 on this. We're going to see some winners and losers.
Right.
Yeah.
Even in consumer, even if it turns down, there will be 100% winners. There were a few consumer stocks that were up in 2008. I like to always remind people of that in a down 35 market, there were a few retailers that were up 10, because there's always share taking that happens.
The last observation I would make, first on margins, Jeff, I agree. Where you may want to look for some potential disappointment on margins is those that are heavily internationally sourced in terms of their revenue streams, because the strong dollar has definitely negatively affected margins. Anyway, the last thing I want to mention, because it does feed into your consumer commentary, the credit card stocks in my space have gotten hit very hard recently. And what was interesting is they literally peaked at the time that Bessent was named head of the CFPB, which is the Consumer Financial Protection Bureau. And they sold off even further when he was replaced, I forget the guy's name, but he was replaced by somebody who basically said, stop all operations at the CFPB, which is imposing restrictions on late fees and other sort of consumer protectionist things. And Trump wants to gut the CFPB and deregulate those companies that were being hurt by the CFPB. So it was interesting that the credit card stocks really peaked when those guys were put in place and started to gut the actions of the CFPB. And they have sold off hard here in February. And part of the reason is they had run up in expectation of this CFPB being dissolved or gutted. But also you're starting to see higher delinquencies on cards now. February was definitely higher than January. Part of that is seasonal, so I want to be careful. And everyone is expecting those delinquency rates to come down in the spring, which would be a typical seasonal process. But if they don't start coming down in March and April, then I think people are going to start to worry about credit, particularly if we have this growth scare. And I want to emphasize the word scare, because we are slowing. People just don't know how much are we going to slow. And so in a growth scare, your highly vulnerable credit operations are going to be sold first. And since credit cards are an unsecured loan, that's going to get sold first. So I'd watch those credit card stocks because they're acting very poorly right now. And within the credit card stocks, you have American Express at the high end, which acts better. But then you have Synchrony, SYF, and Bread Financial, BFH, that are acting the worst. So you can see the subprime guys are acting the worst, whereas the American Expresses are still doing fairly well. Although American Express did see a fairly big jump in their February delinquencies. And that was also echoed by Bank of America's small and medium-sized business lending. So you're seeing some deterioration at the low end of the corporate sector, which relies very heavily on credit cards for their spending plans in these small businesses. And they are seeing higher delinquencies and higher charge-offs. So that was interesting as well in terms of the credit cycle, because that's where it would begin, at the lower end.
Question is that where it stays, right? We've been in a K economy for a long time, and probably the difference between GDP growth and not GDP growth is whether or not the top half of the K will keep spending.
Yeah, and that's why I go back to my comments about the housing market. The first leg down has been a function of affordability problems, and I think the second leg down, if I'm right, is going to be a function of unemployment. And I think by the end of this year, we'll see higher unemployment rates.
Got it. If no one has anything else, I'm going to wrap it up here. Thanks for joining Wall Street Beats this morning. We'll be back tomorrow with more thoughts, more ideas. Check us out online. There's more on the website, wallstreetbeats.com. Thanks for joining.
Thanks, Berna.